I'd like to bring on our first program. Mark is going to talk about closely held insurance companies in Atlanta, Georgia. Please make welcome, Mark.
Thank you, Jan. Should go use this? Yeah. Well, thank you. I actually flew in from Indiana yesterday. I'm actually pinch hitting today for the owner of our company, Mark Jacobs. His name's Mark, too. He was in the airport, didn't come out here yesterday, and had a family emergency that he had to deal with, so I'm going to pinch hit for him today. And I'm glad your backs are to the lake. I'm sure this is hard to compete with in this room. I'll do the best I can to get through this topic. How many of you have heard of captive insurance companies before? Okay. How many have been involved in a captive insurance company or implementing or have clients that have? No one? Okay.
I have.
You have? Okay.
I've heard some cases for your company.
Okay. I'm with Captive Alternatives, and we have been in the business of implementing and managing captive insurance companies since 2000, so we've had 13 years in experience in this. But we have been around since 2000. Our business has grown and doubled in size each year of the last 3 years, and I think a lot of that has to do with people are getting sick and tired of being sick and tired of several things. One of those is more and more people are becoming more comfortable with their own risk, their risk of claims with regards to insurance. A lot of people, today's commercial policies are getting thicker, they're not getting thinner, which means they're adding more exclusions into the policy. So you think you have something covered, but it's not really covered. And so captive insurance companies have become more and more popular for covering those types of what I call Lloyd's of London type risks, where there's a low probability of claim, but the claim could cause a high catastrophic event for your business. The other thing is, why I think they're gaining in popularity, is more and more jurisdictions are making it more affordable for business owners to form their own captive insurance companies. When we got into this 13 years ago, all of our captives were offshore. Now, I whisper offshore because within today's environment, you mention offshore, people think money laundering, tax evasion. It must be illegal because you're going offshore to do it. That's not the case at all. The reason why people were going offshore to form their captives was because cost to do it. As a matter of fact, the biggest landmark case with captives is UPS. UPS, when they were in Greenwich, Connecticut, decided that, we're paying all these premiums to the commercial insurance carrier. We have little or no risk. Why don't we form our own insurance company? And let's domicile it in Bermuda, because it costs less to capitalize an insurance company over there, and we can operate the business company over there much better than we can here. Less regulatory oversight. So UPS formed this captive insurance company. They're making tax-deductible premium payments into their captive insurance company. They were managing their risk. And I'm here to tell you today, there's not an insurance company in business today, Geico, State Farm, United Healthcare, Travelers, CNA, Cigna, you name it. There's not a commercial insurance carrier in business today to pay claims. That's not their job. Now, that's what they'll tell you. But their role is to manage risk and to make money in investment income. That's what they want to do. Insurance companies, commercial insurance carriers, enjoy some of the best laws of any businesses in America. Did you know a commercial insurance carrier could hire an actuarial firm and ask them to do a feasibility study, an actuarial study, and say, what do you think we're going to lose in claims this year? And they'll say, well, we think for every dollar you take in, you're going to have 80 cents out in losses. And that insurance company can write that off that year. And they never have to report their actual losses. And I'll give you a perfect example. We work with a lot of physicians in New York in medical malpractice insurance. Medical malpractice insurance in New York is in a serious crisis. There's 2 carriers left in New York. Several years ago, they came out and these two carriers wanted to have a 15% rate increase across the board for all physicians. The doctors were crying foul because I had an OBGYN that was paying $230,000 a year in premiums for $1.3 million coverage. So the state legislature called the two companies in for a hearing, and this OBGYN client of mine actually was invited to come in and testify on behalf of the physicians. And they had the CEO of one of the insurance carriers up there, and they said, we are experiencing 150% loss each year for the last 5 years. And our premium is 50% deficient. We need a 15% rate increase. This was their justification for a 15% rate increase. So one of the congressmen scratched his head and said, I'm not really good at math, but if you're having 150% losses each year and your premium is 50% deficient, don't you need a 200% rate increase? Or are you about to become insolvent? They said, no. We're not about to become insolvent. I didn't say we're going to become insolvent. Solvency is not an issue. We just need a 15% rate increase. Now, that's because they don't have to report what they actually lost. So think about that the insurance companies are not in the business to pay claims. They're in the business to manage risk. And take that concept to a business owner. What if we went to a business owner and said, Mr. Business Owner, what if we could convert your insurance expenses that you're paying now into possible assets? What could that be worth to you? Take how much you're paying in premium, times the average rate increase that you've had over the last 5 years, times the number of years you're going to continue to pay those premiums, and that will equal the total cost of your insurance premiums over the life of your business. Now deduct the claims that you've had. And what could that be worth to you? So a lot of business owners tell us hundreds of thousands, if not millions. All right, let's see if I can get this to advance. It was working a while ago. Captive insurance companies, as I mentioned, transform insurance expenses into long-term assets. And this is accomplished by the business owner forming their own captive insurance company that would be owned by them or an LLC or a trust. Now, this captive insurance company will share in some of the risk. It can co-insure existing risks. What do I mean by that? Think about health care or workers' comp or for your physician group, medical malpractice insurance. These are high probability claims. What if you went to your commercial insurance carrier and said, we want to take on a high deductible? Let's take health care, for example. You go to your carrier and say, the employees got their deductible, they got their co-insurance, they got their co-pays. What if you went to the carrier and said, now we as an employer want to add on a $10,000 deductible or a $15,000 deductible per employee. And then we want to issue through our captive a high deductible policy. So you're making those premium payments to your own captive insurance company. The commercial carrier is still on hook for the catastrophic claim, so it doesn't wipe out your captive. So that's what I mean by co-insuring existing risks. Or what about those self-insured hidden risks, those exclusions that are in your policies now? Those are the type of policies, coverages that are low probability risk with a high catastrophic event. What if we can now insure those things inside our captive, such as, I'll give you a perfect example. Have a neurosurgeon client now. He's been a client of ours for 7 years. I've met with him and his group out of Tulsa, Oklahoma for 4 years and tried to get them to do a captive for their medical malpractice insurance. The group just couldn't get comfortable with their med mal risk. So he picks up the phone, he calls me in October of 2006 and says, on a Saturday afternoon, and says, hey, I was wondering if you could have a phone conference with my tax attorney, my CPA on Wednesday. I said, well, sure. Why are you calling me on a Saturday afternoon? What happened? He said, well, my sons and I just came back from a fishing trip where we chartered a boat out in Madagascar. And we went out for a week, had a great time. We came back, and as we were leaving, we met the family that was going to charter the same boat for the following week. When we got back to the States, we found out that boat was kidnapped by Somalian pirates, and they were demanding a ransom. Didn't you say that one of the things I could insure inside a captive insurance company was international travel or international kidnap and ransom insurance? And I said, well, sure. Yeah, you can insure against that. Low probability of risk, but could have a high catastrophic claim. So he ended up implementing a captive. He decided we insured some other hidden risks. He was a physician, so we insured against loss of hospital privileges. What if he lost his privileges to hospital? Would that be a financial catastrophic event for him? Absolutely. What if he lost his license? What if he lost patient referrals? He bought international travel insurance. He bought corporate disability. He has a whole host of things where he was paying $400-some thousand in premium into his captive insurance company. These premiums were tax deductible. Today, he'll tell any of our prospective clients or any of your prospective clients that when he did that decision 6 years ago, he wasn't thinking about he was going to save $250,000 a year in taxes. He wasn't going to create all this wealth. He was concerned about the risk. But he managed that risk. And today he says, I've accumulated more in my captive insurance company in the last 7 years than I've been able to accumulate in my qualified retirement plan in the previous 25. So that's what I mean by hidden risks. Or what about customized risks for the business? We were talking about farmers. You know, what kind of risks do they have that we can customize? If we can get an actuary to actuarially determine the premium, we can insure it. So those are the type of the things that are being insured inside the captive.
Oftentimes, like employee theft, or if you got audited by the IRS, type of thing.
Yeah, we have a tax audit and legal defense policy that you can buy. We have regulatory investigation policy you can buy. These are all the types of policies that people don't buy because low probability of claim. Why let the commercial insurance carrier get those underwriting profits and investment income when you can have that inside your own captive insurance company? We do take our clients through underwriting. We will sit down. We have a 57-page application. We don't have the client sit down and fill that out. We will go through that with them and try to identify those risks that they have in their business that they would like to have coverage for. So we take them through an underwriting process. We help them manage that risk. We have risk management programs because we want them to be just like the commercial carrier. If you manage your risk, you get the underwriting profits, the investment income out of your captive. It becomes another profit center for the business owner. And the goal for every business owner in our captives is to get all these assets back at the end of their coverage period or at a time of their choosing. I forget who I was telling. I think I might have been telling you that we have a captive client that's been a captive. They got in 20 years ago, all right? But they're now a client of ours. They have 9 captive insurance companies. And they have all their families own part of the different captives. And when a capital, by the way, when distributions come out of a captive, they're capped at capital gain or tax at capital gains tax, which today are 20%, 23.8% if you add Obamacare. Before the tax rate, the capital gains tax rate increased at the end of the year, this family wrote a check for $41 million out of the captive and paid the 15% tax rate and distributed it out to the owners. So that's the goal, is to get these assets back at the end of the coverage period. Here we go. What we're finding out is captive insurance companies are becoming the core, sometimes it wants to work, of a business owner's financial plan. And I've already mentioned that the strategic insurance planning, we can co-insure with other commercial carriers and choosing high deductibles and getting premium to their own captive. We can insure against those hidden risks or those Lloyd's of London type risks that I was talking about. The strategic tax planning. The key to a captive is to make sure that we follow all the regulatory regulations that have been put down for insurance companies. Risk distribution or risk shifting. Your captive has to share in risk with other captives, or there has to be some kind of a fronting carrier that's taken on the majority of the risk, which we'll talk about here in just a minute. If you follow the guidelines put forth by the IRS, which we do. Matter of fact, we've had 47 of our clients that have gone through audits in the last 13 years. Not because of the captive, but they were audited for some other reason. And all 47 of those captives were audited, and all 47 passed with no change. So we stand behind our work product. We're doing it the right way. If you do that, then you get all the strategic tax planning. The premiums are tax deductible. We file these captives under IRS Code 831B. I know that doesn't mean anything to you, but let me tell you what it means. A business owner can pay up to $1.2 million in premium per year into the captive, and reserves are not taxed. Now, there are taxes paid on the net investment gain. So if you get your 10 to 12% rate of return for them in the investments, put $100,000 of premium in, that earns 10%, they have to pay tax on the $10,000, not on the $110,000. So it's a very good tax law. You want to know where the IRS with is? They've raised that limit. It used to be at $600,000. So captives have been around for a long time. And then I already mentioned when the surplus is distributed out, it's taxed as a capital gains tax rate. So there's strategic tax planning that can go along. Maybe I need to be on this side.
Wouldn't the tax planning, Mark, coincide with that person's individual timeline of how long they want to get stay in business?
Yeah,
Before
right.
they retire?
Right.
It could be 5 years, it could be 10, it could be 20.
And we run into all different scenarios. We get a single business owner. We insure a lot of doctors. We have doctors that are all, there's 5 doctors in a group, and they're all at different stages in their career. One may get out in 5, one may want to practice for 20. We do a per partner analysis that we can take them through, because when we run into multiple owners, they say, well, this all sounds great for the business, but what's in it for me? And we can take them through that per partner analysis. But yes, that is correct. Strategic financial planning. Again, to ensure it gets the company's long-term self-insurance needs. Every year we will go through a review process with the business owner. There are new needs that come up. We can help them ensuring those new needs. I've already talked about the strategic alliance planning, the legal planning, business succession planning. This doctor, Dr. Chris Covington, and I mentioned his name because he says, mention my name, I'll talk to anybody. His captive has become the core for his business succession planning, for his family succession planning, for anything that to do with his wealth transfer, estate tax, all that comes out of the captive. And obviously, strategic wealth planning. The captives they become a war chest, if you will, another profit center for the business owner. Just some captive industry known facts. As I said, 13 years ago, we did all of ours offshore. Half of ours are domestic, and half are still offshore. 5 years ago, there were 15 states that enacted captive legislation. We are actually sitting in one state where they are one of the industry leaders, Nevada. But today, there's over 30 states that have enacted captive legislation. They're making it more cost affordable for people to form captives in their state jurisdiction. This is kind of like the McDonald's sign. It's changing all the time, right? There are over 5,600 captives today. There's probably more than that now. Captives represent 20% of the world's property and casualty insurance. They account for over 10% of all insurance premiums collected worldwide. All 30 Dow Industrial companies and over 80% of the S&P 500 companies have their own captive insurance companies. Now, I say all this just to let you know that they've been around for a while. What we at Captive Alternatives have been able to do is bring it down to the smaller employer and help them with to enjoy these same benefits that the Fortune 500 are enjoying. So this isn't anything new. By the way, where do I think captive legislation is going? I get that question all the time. I don't think it's going anywhere because most of our Congress people have their own captive insurance companies. John Kerry, his wife has 7 of them. It's Warren Buffett's largest asset. Isn't he best buddies with Barack Obama? If they mess with the captive insurance industry, they're messing with the Fortune 500 companies in the Dow 30. Now, could there be some changes in tax legislation with regards to them? Maybe. I mean, that's always a possibility, but we think they're in a great position right now. So to wrap it up, a captive insurance company is a small insurance company formed by the business owner to cover their hidden risks or customized risks to their businesses. We still can domicile them in the international jurisdictions. We use the Turks and Caicos and the BVI. Domestically, we use Nevada. We use Kentucky. Usually I get a laugh when I say Kentucky. We use Utah. Utah is a good jurisdiction for captives. And we have the state of Tennessee, former doctor who's now one of the congressmen in Tennessee, courting us to move. We are moving one of our captives to the state of Tennessee. So we can do domestic or international. And what does it depend on? It depends on the client's comfort level.
Of your clients, how many put in the full 1.2 million a year?
I'd probably say 25%. Most of ours, our average premium is around 500,000. We'll go down to as low as 100, where it makes economic sense, because there's a cost to do this, and there's a cost to manage it. So we think it makes economic sense at 100,000 or more. But the captive is an insurance company. It's not a qualified retirement plan. It's not a supplemental 401k. It doesn't follow those kind of guidelines. It has to follow the regulatory requirements of insurance companies. And if you do that, then you get all these benefits that I'm talking about.
Mark, that 100,000 is annually, correct?
Yes, that's 100 annually, yes. We've had some captives where they've put in premium and then the next year they can't put in as much. That's okay. The captives have that flexibility. You just buy less coverage. You know, it's not a fixed cost annual. And if somebody, I'm going to use fixed numbers today, and when we look at a chart, but all these premiums are actuarially determined. If somebody says, I've got $300,000 that I can afford towards premiums, we're not going to come up with coverages that are exactly $300,000. It may come in at $291,000, $300,000, depends what the actuaries can determine the premium is.
I think you brought up a good point about the estate planning issue, where many companies will have their heirs own the captive company. So now they bypass federal estate tax and get that, which is half the whole time.
We have some of our captives are owned by IRAs, or some form of a trust or LLC for not just the tax issue, but also tax avoidance issue, but also for the state transfer to the family members in a tax efficient environment. There's our range of premium. If do we have clients that pay more than 1.2 million in premium? Yeah, absolutely. What do we do in that sense? We just form more captives. I'm leaving for San Francisco. When I leave here, meeting with a trucking company out there who has 2 owners, but they have 6 entities within the division of the company, and each entity will have its own captive. And that captive will insure, like, for example, one entity is for the real estate. And so we'll put coverage in there that's specific for real estate. One of it is for the equipment. So we'll put coverage in that captive specifically for the equipment. One entity is for the truckers and life insurance. So there's just all different kinds of things. What you'll find out is captives have the ability to create a tremendous amount of flexibility. All right, here's how it works. Here's how we do it, all right? This is kind of the 30,000-foot view of the step-by-step process of how this works. Here's your business owner, all right? He currently carries commercial coverages or those numerous self-insured risks or those exclusions that are in his current commercial policies. In our model, he will purchase coverage from a company called Madison National Insurance Company. Madison National is a captive. Madison National will provide the fronting for risk distribution. They will pay their premiums to Madison, and Madison National will issue their policies on their selected coverages. At the same time, the business owner forms their captive. Their captive technically is a reinsurance company to Madison National. The premiums go to Madison National. They will cede 60% of that premium on day one down to their captive. Madison National will hold on to 40% of that premium for the claims made period. These are claims made policies. The claims made period is 1 year. After that claim, now Madison National holds on to 40% of that premium, but Madison National is on the hook for 50% or more of the claim. When that claims made period is over, Madison National then will cede or push that 40% premium down to their captive, less any pooling fees, which range between 3 and 5%. So at the end of the day, What the business owner gets is about 90% or more of their premium in their captive each year. Year 2 comes along, that reserve in there on that 1-year premium now turns to surplus.
And where's the majority of that money banked?
While the money is in reserves for that first year, they have to be in very conservative money market type accounts because the money needs to be there to pay claims. Once the claims made period is over, that reserve is then converted to surplus. Once money is converted to surplus, then you have a little bit more flexibility, you'll be a little bit more aggressive in your investment options. Yes. Now we don't, you're going to ask who manages the money? Yeah. We don't manage assets. We just set up the captive and we manage the captive. We make sure you're in regulatory compliance. We adjudicate any claims. We are making sure that we do the tax returns for the captive. We manage it from soup to nuts. The business owner does not have to do anything other than pay.
Is it TPA or is it Madison National TPA?
Madison National. Actually, Madison National just serves as the fronting company. We have another company called Valley National that actually does the TPA work. They manage the captive. Make sense?
What's your relationship with Madison?
Our company, one of the principals, Mark Jacobs, who was supposed to be here to speak, he and a few other people own Madison National. But Madison National technically is just a holding company to meet the risk distribution. Madison National has not paid a large claim in 7 years. We've had smaller claims like these deductible policies for health care. We're getting ready to come out with what I consider a sizzling great product for health care, hopefully by the end of the year. And it will be Obamacare compliant to help drive down the cost to the commercial carrier further and get more of those premiums to your own captive. But we've had small claims come through there. Again, the business owner owns the cap. They own this 100%. Now let's take a little bit more detail. By the way, I had handouts for you, or Mark Jacobs did, but they're still in Atlanta. When his emergency came up, he didn't get them shipped over here in time. But if you give me your email when we're done, I'll send you a copy of this presentation. What's that? Is that it? Did they send them? Okay. I didn't think they sent them. I can send this presentation to you when we're done.
Just out of curiosity, kind of like an insurance or umbrella policy, that the opposing attorney knows you have $10 million, all of a sudden the suit's $10 million. Do they have any sort of carrier for that?
No. Madison National is no different than a commercial carrier. There are caps on your policies, right? If your house burns, it's not going to give you 100% of your value of your home, right? If you have an auto accident, it's not going to give you 100% of value of your auto. There are caps on these policies. So let's say that the cap's $1 million. That's the most they can they sue for the additional assets in the captive? No. Because those are assets of the insurance company that are there to pay claims.
Even though it's a surplus?
That's correct. All right, so they make their premium payments to Madison National. Now, Madison National currently is domiciled out of the TCI, because that's where we domiciled it 13 years ago. But we are in the process of domesticating. This is the company we're moving to Tennessee. They've enacted some great captive legislation. Their tax rates are low. It's a competing industry out there between these state departments of insurance that are in captive business. I had a meeting when I helped put together a Med-Mal company, Med-Mal captive. It's actually domiciled here in Nevada, and I was meeting with the regulators and the commissioner of the Nevada Division of Insurance, and they said, we once were the second largest jurisdiction for captives and risk retention. We've moved to fourth. And they just hired a new deputy commissioner. He said, our goal is to get back to number 2, if not number 1. So it's no different than any other business. These bureaucracies are competing for business. Again, Madison National will hang on to 40% of the premium for 50% of the risk. And these are just some different types of coverages that Madison, and the next two slides we'll look at will list a lot more different types of policies that we're issuing, but tax, audit, legal expense reimbursement, employment practices, sexual harassment, age discrimination, those kind of things. You think they may have commercial coverage, we're seeing a lot of exclusions in that area. And this is where an employer can ensure those exclusions in their own captive. Loss of key customer, loss of key talent, regulatory investigation, cyber risk, corporate disability income, loss of key supplier, high deductible policies. Now, these high deductible policies are what we're issuing for health care or workers' comp or medical malpractice insurance. All right? So Madison National will cede 60% of the premium to the business owner's captive, and they'll retain 40%. Why 40%? Where did that number come from? We are following two private letter rulings issued by the Internal Revenue Service in 2009 that they say if the fronting carrier keeps 40% of the premium, then that meets the IRS's requirement for the safe harbor of risk distribution. So that's why we come up with the 40%. Some...
You can automatic pass if you put in 40%.
Beg pardon?
You give you an automatic pass if you put in 40%.
Yeah, that's the safe harbor test. And that's probably why of the captives we've had audited, they've passed. That's the key, that these are really insurance companies. There really is risk involved. Questions? Does this make sense?
For someone looking at it for the very first time, it might seem a little confusing, but if you said take the word insurance out of it, it's a wealth building tool. It would be a very much better explanation.
From your standpoint, that's probably true. From our standpoint, guess who doesn't like a tax deduction? The Internal Revenue Service, right? The IRS. So we have to be real careful with what we promote. This is an insurance company. But if you run it like an insurance company, which is what we do for the business owner, it can become a wealth accumulator. It can become a tax-efficient tool. Warren Buffett, did anybody see a couple years ago, he was on 60 Minutes and he was complaining about how little tax he pays? Yes. Anybody see that program? Yeah. Well, you know why? You know why he only paid about 17% tax? He's taking dividends out of his insurance companies and paying capital gains tax when it was 15%. I wanted to pick up the phone and call 60 Minutes and say he could pay more. If he wants to, but that's why. I mean, he understands. I mean, he even said in that program, an insurance company is a license to print money.
How did you get only one large insurance claim, and you said you only had one large insurance claim?
Well, we haven't had any large in the last 7 years, and here's why. Okay, most people are insuring these low probability, I call them Lloyd's of London type risks. Low probability of claim. They're managing their own risk. We actually had a client 2 years ago, and maybe it was a loss. I can't remember what the claim was for. It's $1 million claim. It was $1 million claim, and he didn't want to file the claim. It's his company, right? It's his insurance company. He didn't want to file the claim. His attorney said, you need to file the claim. Well, by the time he did it, he was outside of his claims made year. So we could technically deny it because he filed it outside the claims made year. Had that happened, we would have had $1 million claim 2 years ago. But he was glad that happened, because then you go back to his attorney and says, well, they denied it because I was outside my claims made year. But the money was there if he needed to pay it, if he wanted to do it. That's why we haven't had very many claims. Now, we've had a lot of little claims. And like I said, they basically come out of these high probability claims like health care and workers' comp, because you can imagine claims coming out of those types of coverages. Did I answer your...
What's been your exposure to increase in TPA costs for those small claims?
Not much. We don't think we're going to have to adjust our costs at all with the claims management of those healthcare claims. Now, that's what we're thinking right now. We haven't implemented it yet. Well, we have it, but we don't have it to the degree. We're opening up this healthcare product for any employer with 2 or more employees. So I tell you the reason we're doing that, one of the reasons we want to see more claims flowing through here. Because we don't want to be accused of not paying any claims. Yes.
Mark, I can think of so many businesses and people I know that this should be something they would look at. I get a feeling because there's so few of these, there are a lot of people that it's a great fit for, and for whatever reason, they find a way to say no. I don't want to do. What is that reason? Is it complexity? Is it too good to be true? What is it?
That's one of them. It's too good to be true. Okay. You want to answer yours, and I'll give the other answer. Go
I
ahead.
sold a couple of cases last December at the end of the year, right like the 16th of the month. And these people were facing some hellacious income taxes. And I said, we can obviate some of those by starting a captive. They were able to take a very large, several $100,000 income tax deduction at the last moment at the end of the year, which was very powerful to their personal position, and will be able to take that same several $100,000 income tax deduction for as long as they want to run it and shut it down. And it's congruent with the person's personal needs. So if the guy's only got 5 more years to run before he retires, what a great opportunity to put together a sincere amount of money on a tax-deductible basis. You only have to pay capital gains on the gains of what you put in the insurance company. So it's, for my 2 clients that I sold, said to me both, why hasn't my accountant told me about this? Why hasn't my attorney told me about this? Why hasn't my insurance agent told me about this? And the truth is that 92% of those people have never heard of this.
Lack of knowledge is a big, most CPAs, most attorneys don't think the employer is big enough. But here's the other reason, okay, and I see this a lot. Right now, when you pay your insurance, you're renting your insurance, right? You pay your premium, State Farm's on the hook. But all of a sudden now, it's a paradigm shift in the business owner's mind. Oh my God, now I own my insurance company. What if I have 20 claims next year and wipe out my captive? Is that possible? Yeah, I suppose that's possible. We haven't had any captive become insolvent. We've had captives shut down because the business became insolvent, but not because of the captive. People got to understand and get comfortable with their own risk. Yeah.
Yeah, I think, to one of my comments, and that was a great question. Yes, Jim, but there's a perfect storm right now in the healthcare industry with, Obamacare kicking in, all the new regulatory environment that's kicking in. It just vastly complicates. So we've socialized this with a number of clients already, and they're real interested. It's a no-brainer, but when you dig underneath a little bit, it gets scary for them.
That's when the good underwriting comes into play. We've got some of the best actuaries, I think, in the country to help not only with the actuarial premium, but the overall risk that may be involved based upon that particular employer, based upon their particular industry, and especially when you get into healthcare, are you putting in these wellness programs, all those kind of things. The healthcare industry is going to be an interesting one for us. But I think from what I can tell.
Well, as far as the deer in the headlights, I think that's part of the question was why are we not a lot of risk aversion? And then I had a question, and that is, okay, so you've got an existing health plan provider, you've got all your insurances, you've got all that stuff. You've got some aging senior employees, highly skilled with medical problems. So does Madison provide all these service lines to them direct, or can you use keep your existing?
Madison National will provide the high deductible policy. All those other services would come through their commercial carrier. If it's Blue Cross, Blue Shield, whoever it is.
Is there a wholesaler, Madison?
Yes,
Okay.
Any type of coverage that you need.
yes. If it makes sound economic sense, yeah. And you can look to maybe insure some of those things. Again, this gets into the risk reward area. What are some of these coverages we might want to cover that Blue Cross is not covering?
Let's say malpractice insurance.
Well, we do a lot of malpractice insurance. We do a ton of in fact, we got a whole different model for MedMal that's really working really well. We've been doing that. In fact, that's what I cut my teeth on 13 years ago was medical malpractice insurance. Doctors are, just because of poor risk management, we're getting suits that were frivolous. I had a doctor, an OBGYN, that got sued for $1 million because she did a C-section on a patient. Mom was fine, baby was fine. 60 days later, she gets this intent for suit, goes to a 3-week trial in New York. And the plaintiff's on the witness stand. And the plaintiff's argument was, I now have this scar on my stomach, and I can no longer wear lowrider jeans. Frivolous. That suit made it that far because the insurance company she was with at that time, it wasn't through our program, had an outdated consent form. And that's what they based it. Now, it went through a 3-week trial. She fought it. She won. In fact, the judge said, you know what, I can't wear them either. But her defense attorney charged her insurance company $300,000 to defend that frivolous claim. And it all started with the improper consent form. And through our risk management program, that would have been discovered during the underwriting phase. So they couldn't have come back on that. So good sound underwriting, good risk management is the key to making these things successful.
So my third thing is just so that scenario where you've got the senior, one of the owners got a major health problem. There has been, I've had a little pushback saying, do we need to cover that when they end up going tanking and needing billions of dollars of health care? Do we have to cover that out of out of the pot? Or is that covered by Madison?
Remember, we would probably, in that situation, it would be a high deductible policy. So that employee may have a $20,000 deductible. Okay? Blue Cross is going to pay the rest. Out of that $20,000 deductible, Madison National pays 10 or more. And your captive pays the other 10. Remember, that's the risk distribution that's going on here. That's what makes all this work.
So are these canned policies, or can you create your own? I'm confused about the risk, because
We can create...
if we've got a cap on the policies, what's my risk? My risk is to my cap, and that's nothing beyond.
That's right. That's right. You can buy excess coverage if the premiums will support it, if it makes economic sense to do that.
Well, what I mean, just in reference to Jimmy's question, why are these people backing away? One of them being the risk. Well, if there's caps involved, what risk is there? What's the cap?
They'll now go back to the lack of knowledge. They just don't understand that there's caps. They have caps now. They have cap. And what if they have a run on claims with the commercial carrier? What's their commercial carrier going to do? They're going to jack their rates. They're going to make it economically improbable for them to carry the insurance, right? So this fear of having the run on claims, is it possible? Yes. Highly unlikely. All right, I get a kick every time I get on an airplane.
But we're still only going to run it to the cap and nothing beyond.
That's right.
Yeah, so there is no risk in my opinion.
Those catastrophic claims for health care, and again, and that's where the actuary and the underwriter determine, well, here's where we think, based on your business, based on your financials, your cash flow, what kind of high deductible policy we think you can have and afford to fund in your captive. All of that is discovered in the feasibility process, which is... No. Well, yes, there is. There would be medical underwriting in relation to the deductible policy, but the commercial carrier is doing the medical underwriting as well. But our underwriters will look at that.
Disability as well?
Yes. Yeah, there's real underwriting being done. We have some really good underwriters. Some of them have come out of the commercial market.
Final question or comment I have. High net worth farmers, and I know a lot of them, that one of their big issues is estate planning, to pass the farm down to their children. To me, this is the perfect tool
Right.
for estate planning with a trust, right?
You have the kids
It's the only tool left.
be the owner of the capital,
Well, I shouldn't say that.
so they can afford to pay the
With
taxes.
the flexibility that it
Or-
provides.
Or business.
That's it, in a nutshell.
I can't imagine these people are knocking your door down.
Well, that's why our business is growing. We used to try to stay under the radar screen as far as our marketing efforts. But I went to Mark Jacobs a year ago and said, why are we doing that? We're doing everything on the up and up. It's a legal structure. The captive insurance companies are in our code section. We are meeting risk distribution. What are we afraid of? We're providing real insurance. We got real risk distribution. We're giving people an option. There's an act called the Liability Risk Retention Act that Congress passed back in 1986. They're called RRGs, Risk Retention Groups. And Congress passed this act back in 1986 to allow the consumers to have an alternative to the commercial insurance carrier. You can go out and form an RRG to insure your own risks. A risk retention group is a domestic captive insurance company. They just require a lot more capital. They're a lot more scrutinized. But now we're seeing these domestic jurisdictions getting into the single parent captive game. It's no different than a risk retention group, honestly. So I think you're going to see more and more. This is my own opinion. You know, opinions are like eyeballs. Everybody's got a couple. But I think that right now the commercial carrier, the commercial insurance is the mainstream, and captives are the alternative market. I think in 10 years that's going to flip-flop. I think that's my prediction. Because people are finding out they can control. They're getting more and more comfortable with their own risk.
What is there, I mean, I know we've been talking about farmers and doctors. Is there, like, you know, I mean, it could be applicable to any industry.
It's applicable to any industry.
Professional, they a doctor or
Like
a
a real
realtor?
estate firm, like
A
a real
realtor?
estate brokerage. is another.
Attorneys have their own captives for E&O. Accountants have their own captives for their E&O. We have all different types of industries. We've got an airplane
Would you say
manufacturer.
percentage-wise is, you know, doctors, you know, large percentage of clients? What's the, like, the tops, let's say, five?
Well, we started this whole thing with doctors, so I would say doctors are probably still about 40% of our clientele. Yeah. 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 Mainly the specialists. Those that have higher risk because they pay the most. They stand to get back the most. And the New England Journal of Medicine came out with a study 2 years ago that said only 2% of doctors nationwide have ever had a claim payout. 2%. But our 1-800-HERD attorneys want you to think that that's 98%. And with the economy being down, lawsuits go up. Because we live in this litigious society where anybody can sue anyone for anything for any amount of money. And in the deposition, the first question the attorney asks, do you have insurance and what is your policy limit? 90% of all med mal claims settle within the policy limit. The largest medical malpractice jury award in this country was $606 million to an 87-year-old chemotherapy patient in Texas. They do everything big in Texas, right? Right? It's settled for $1 million. Now, how do you get from $606 million to $1 million? Policy limit. We know your insurance will pay. But the onset of good risk management for physicians has curbed those statistics. More doctors are being able to say, no, I'm not going to let you settle. I'm going to fight this thing because I've got all the documentation provided up front. And most attorneys aren't taking these frivolous cases anymore because they're losing. And a lot of those are coming through these alternative strategies where the doctors have control. I think that's the biggest advantage of a captive for any business owner is they now have control.
Hey, jumping back to the high deductible
Yep.
program that you guys are talking about starting or have started, how does your TPA tie in with like a Blue Cross structure or?
Well, Blue Cross is going to adjudicate their claim,
Right.
and they're going to say, I'm sorry, we don't pay anything because this all falls under your deductible.
I'm just trying to find out how smooth is that transition?
We what's they call it? We don't subrogate with the commercial carrier. They process their claim, they go to the employee and say, or to the employer and say, we don't pay anything because it's below your deductible. Then the employer files the claim with Madison National. It's completely separate.
Is there any way to be able to tie that together?
I don't know. I don't know if we want to be tied to the commercial carrier. I mean, but I don't know, you know.
One interesting thing about,
That's a good question.
Like a section 125.
Yeah. Cafeteria type plan, yeah.
one interesting thing about owning a captive is you control the claim.
You can what?
Control the claim.
You can control the claim, yeah.
Pay that claim or not.
Yeah. You got to file a claim against yourself, basically. And we've had some business owners not file a claim in their captive and pay it out of the operational costs. Like I said, I like to see more claims come through some of our captives. Just legitimizes further that these are insurance companies. And I think we'll see that down the road. These next two slides are just types of coverages that Madison National currently is issuing. Those in blue shaded are some of our common ones. The one down here shaded in green, we've seen business owners that are looking to sell their business or purchase a business. You know, there's all these warranties that are in these sale agreements. You can fund against the shortfall of warranties in your own captive. So we've seen a lot of that. Loss of key talent, I'd say is our most popular. Yeah. Loss of key talent and loss of key customer. How would that affect your business or business owner? Cyber risk used to be a big one, but there's so much of it being written now, the rates have come way down. So you can't get as much premium out of cyber risk as you could before. Madison National, as I mentioned, they're in the Turks and Caicos, but they filed the 953D election, but we're in the process of domesticating it to the state of Tennessee, which will probably happen sometime at the end of this year, beginning of next year. All right, here's just, I want to just go through, this is an example of a premium through the captive that's receiving $500,000 a year in premium. We're going to look at a scenario where this captive is paying out 15% loss each year, which has never happened, but let's be conservative, right? What if we have losses each year? I used to show 5% because I thought that was high, but let's move it to 15. We have one business owner. This is where if we had multiple business owners, we could do a per partner analysis. And we're going to assume they're earning 5% rate of return on the investment income of their reserves and surplus. So we put together a little bit of a table. All right, and what we're going to factor into this is what's it cost to start the captive? What's it cost to maintain the captive? We're going to assume 15% loss each year. We're going to assume 5% rate of return. All right, the premium is $500,000. All right, our cost to set up a captive is $5,750 per $100,000 in premium. That'll get you a licensed, regulated captive insurance company. So now we got $500,000 in premium, so that means the startup cost would be $28,750 just to form this captive. Every captive, per regulatory requirements, has to have capital. Capital is separate from premium. Our capital requirements for any jurisdiction is 25% of premium. So we got $500,000 of premium, so that means that $125,000 has to be, that means the captive can have no less than $125,000, and it will be deemed every year a legitimate insurance company in the jurisdiction that we choose. So the total flow to get into the captive is $153,750, of which $125,000 is their own money, their capital. We have one partner, so the cost per partner is $153,750. In 5 years, we're looking at 5 increments here. In 5 years, we would have paid $2.5 million to the captive. At the end of that 5 years, 89% of those premiums are inside our captive insurance company. That's what the assets are. Again, assuming paying out 15% each year, assuming earning 5% on the investment income. And we're also taking out the management costs to manage the captive. So that equates to $2.2 million in assets. If we did a lump sum distribution of those assets to the business owner at the end of 5 years, then after the capital gains tax, they would get $1.7 million of cash out of that captive. Now, we've had captive owners do this. We had a car dealer who had $3 million of surplus in his captive. He shut it down. He said, liquidate it. Paid a 15% capital gains tax, went down the next city and bought another car dealership, and then started another captive insurance company with both of those dealerships. We've had some business owners that will borrow the money out of their captive, borrow some surplus. You have to have a performing loan, got to pay it back, but it's tax deductible interest to your captive. All right? That way they got the money income tax free, but it has to be a performing loan. If you don't do it a performing loan, guess what the IRS will say? Pay taxes on that. This is not a legitimate loan transaction. Again, if you do think, look, our tax code's 64,000 pages long. I'm sure every one of us know what's in those 64,000 pages. There are some really great things inside there if you follow the guidelines. But guess who doesn't want you to know the guidelines? Right? So anyway, this just shows, okay, that's $500,000 in premium. We also have, this is a million, 1.2, if we're maximizing the 831B captive, the 1.2 million, the numbers are just exponentially bigger, okay? But look at that. Return to premium plus on the coverages you have inside your captive insurance company. And these numbers I'm showing you are real that we're seeing with our clients, except for that. We're not seeing losses like this at all.
So the number's actually higher than.
Yeah. Yeah. We've already touched on this, I think. Here's the other planning opportunities that come out of a captive insurance company. Again, if you got anybody that we've got all kinds of references of clients that will talk to your clients. Dr. Chris Covington is one of my favorites because he was a Debbie Downer when I was going through this with him back in 2005, 2006. Now he's just like, have him call me. Who do I need to talk to? We hold a conference once a year where all our captive owners can come to. And he just goes around and just talks. He believes in it because he understands his own risk. His wife is in the oil business. Family's in the oil business in Oklahoma. I think they have like 48 oil rigs. They've done their captive, and they've done all their estate planning focused around their captive. I've already touched on this. If you've got several entities, each entity could have its own captive. We have this situation already with some of our clients. Costs, I've touched on this. $5,750 per $100,000 in premium. We cap it at $54,600, which is about $950,000 in premium. And if we have multiple captives, we will cap the cost. 25% premium for capital. What does it cost to manage the captive each year? It's based on a decreasing amount of premium. We start at a high at 13.5%, which is on $100,000 of premium, to a low at 6.75%, which is $1.2 million. I can tell you right now, you get that kind of premium, everybody wants to negotiate that fee. We'll negotiate fees, okay? I won't, but Mark and his team will. From the time we get the data, the applications to form the captive, we can have it formed and ready to go in 6 weeks or less. Now, having said that, because of the tax attributes and the tax efficiencies with it, we have a lot of our clients come to us in October, November, and December. Because what are they thinking? Tax time. I got to get some deductions. So we get really busy in the last quarter of the year. If you got clients that are thinking about this, I think now would be the time to start looking at it. Now, here's the best feature of all, I think. The business owner can pay for all the costs, the capital, and the premium, or they can obtain their own financing. We at Captive Alternatives have a relationship with a company called First Insurance Funding, large finance company out of Chicago. They will finance the startup costs, they will finance the premiums, and they will finance the capital. All right? When they finance premium, they require 2 months down payment, and the balance is billed over 10 months at 5.75%. On capital, it's 20% down and 5.75% capital, and startup costs are thrown into this number here. 85% plus of our clients finance their premium and capital, and they finance it every year. Why? Because they like cash flow and manage cash flow, and their captives are fully funded on day one. Plus, they like the tax deduction of the interest on the financing. So we have that financing available. Yep.
If I would assume our company.
We're about done.
I would assume our company would be too small for this, but is it a possibility of placing 2 or 3 companies?
Yes. Doctors do that a lot. We'll have different practices that are small practices come together. They all own their own practices, but they come together and all own the captive to get the economies of scale and the premiums. Yes, and they all, yeah, that's possible.
Now, if you were wondering where those dollars get invested inside of the captive after the 15-month period, I'd like to introduce you to 2 gentlemen that will enlighten you, Daniel and Jim. Jim is from Royal Metals Group, Bettendorf, Iowa. Daniel from London, Texas, president of Asset Exchange Strategies. Jim is the vice president of Royal Metals. Jim, can you speak a little bit about metal?
We are a major precious metals dealer. I'm going to shorten this up considerably on the next slide, so you have an opportunity to listen to Dan. But we're a major precious metals dealer. We deal with one of the largest, if not the largest, refiner in this country, and they're a major market maker throughout the world. Everything that we market, everything that comes from Royal Metals Group is guaranteed to be genuine and pure. We do not report your purchases to the IRS or the federal government, and there is no sales tax involved when you purchase through Royal Metals Group, regardless of what state you reside in.
That's not true in Nevada. Here, the folks that buy metal in Nevada, they have to pay the full tax.
But not with Royal Metals Group, and that's correct. We're not located in the state of Nevada. But at any rate, we do a lot with high net worth investors throughout the country. High net worth investors, I get a chance to work with a lot of them through our very fine advisors like Jan. They have 4 things in common. They all own essentially the same things. They have a significant position in tangible assets, which is made up of income producing real estate, physical gold, physical silver, and usually oil or some energy related investment. The high net worth people I've worked with over the years throughout the country have about half of their portfolio in tangible assets across the board, as I've discussed. But again, what I'd like to do with this shortened amount of time is, and I'll be happy to follow up on any questions you might have through Jan. I've worked with Jan a great deal. I like the captive thing. I'll mention one more thing. The captive insurance companies, many of these owners choose to put a portion of those funds into physical gold and silver because it's so very liquid. It fits a CIC very well, and it's very liquid. Particularly the reserves. And with that, I think I'll turn it over to Dan Cordova with Asset Exchange Strategies. I'd like you to hear about what he has to offer you.
How long do we have, Jan?
Go ahead and take another 12 minutes.
12 minutes. Well, what we do is we capture and compile and manage alternative assets for clients. So what that means is if you have alternative assets such as the silver, such as real estate, notes, generally it's left up to you to manage all of those things. And if it's in a product like a CAC or maybe in an IRA or 401k, the management slips through your fingers. There are compliance issues that you need to take care of. And we have found over the last 13 years that we've been in business that clients do not do that. And so it leaves a hole for them to have to manage. Now, we may be able to find a policy, an E&O policy for handling your own self-directed IRA. I don't know. But what we do is we help source the products and then manage those products for the client at a fee of about 1.5% of assets. We do not charge a fee for the resulting cash flow. We do not charge a fee for the incoming assets that come in. So if you are looking for a place that you want to be able to source alternative assets, manage them, make sure they're compliant, that's what we can do for you.
Would your company be a good one if I said, my clients have IRAs and it's time for them to turn their income on now, and they'd like to get their income next month?
Absolutely.
12.5%, would that be in your realm?
Absolutely. You know, we're quoting through RMG 9 to 10%, but it's quite probable that you're up in the 17%, 20% without any additional risk. And this is through the real estate markets that we're in. They're small entry levels, and so the risk is minimized, and the return on investment is very, very high. The opportunity, again, to manage that cash flow comes right back into metals, or you could put it into notes, whatever it is that makes sense for your situation. And the little I understand about the CICs is that the initial categorization or capitalization of those insurance companies, we won't be able to help you with. But the surplus, certainly we can do that with. And once the capitalization of the insurance company gets to a certain point, we can start putting those assets in there. It's the 15 months, okay.
When the data started.
Right.
You're going past your 1 year.
Okay.
But can you speak a little bit about some of the specific assets that your company is offering currently?
Sure. We specialize in the largest growing demographic in America today, and that's the blue-collar market, finding housing for that market. You've heard about all those jobs that are being created in the last few months. Those jobs are all blue-collar related. Not all of them, but a majority of them are. And so that's the largest growing segment out there today, and these people want somewhere to live. Typically, the rent that is coming in is about $700. Typically, the weekly wage that is coming in is $700 a week. So it's about 25% of their income. Very reasonable that they're receiving. These people are receiving homes that are renting homes that are renovated, that what I call Home Depot bling, so it's not extravagant, but it's certainly what they like and what they want. And they're on a long-term lease. So these cash flows are returning on to you about 15% on average. They could be as high as 25%. We can buy in multiples, so if you want to buy a small apartment building, for example, and get a nice little cash flow, you can do that. But we buy in regions like Indianapolis, for example. Very good economy there. There are probably 20 small colleges in that area. If there's a small college, you need student housing. All of these areas have several different industries that are supporting that economy. So there's not one particular industry, Las Vegas, for example, that is supporting an entire economy. Any other? Help me out.
Can you talk to me about some of the smaller homes that you folks are using?
Sure. Let me pull up
the IRA qualified.
Yeah, let me pull up an example here.
I thought it was a very easily saleable. I could see people buying a dozen of these.
Absolutely. At an average price of $40,000 per property, it becomes very, very tangible for people, especially if they want to leverage them at 50%.
So you'll lend them a guaranteed loan if they'll put at least 50% down on a
Yes.
$41,000 home. And what's the rate of return on that money?
Well, that rate of return is typically another 5 or 5%. So if you were getting 13% paying cash for a piece of property, then you're going to get 18% on a leveraged piece of property. Now, here we go. Oops. Here's a piece of property that is in Birmingham. The purchase price in this particular case is $42,000, very typical, although they are going up incrementally here. And this guy was built in 1928, and you say, oh, my goodness, that's a old building. Well, it is, but the bones are good. That property is going to last another 100 years. All right, square foot, $13.12. Cost per square foot, $32. 4 bedrooms, 1.5 bath. Now, in the Midwest and back east, 1 bath is very, very common, unlike here in California. All right, in this case, the typical monthly rent is going to be about $725. Very typical in the Midwest and the South for that price range. Annual rent is going to be $8,700. Taxes of about $1,000, very typical again. The insurance will be $700, management fee $870, and the management fees range depending on what area we're in. Vacancy and maintenance, $783, but that is a number we're putting in there as an act of conservatism on your dollars. They probably will not go against your income. In this case, your total expenses will be $3,400. Your net income will be $5,247. In this case, 12.5% mailbox money into your mailbox, your IRA, your personal bank account every month. Now, let's take the same piece of property, $42,000 with the purchase price of $21,000 on the, it's the financed amounts, I should say. A cash down at an interest rate of 8%. Now your adjusted net income is $3,500, and your financed cash-on-cash return is 16.99. Now, the wonderful thing about this is you don't have to worry about toilets, you don't have to worry about roofs, you don't have to worry about any of that stuff because we manage that for you. We're the first ones to get the call. Oh, the wind knocked down the tree. It needs to be repaired. In situations like that, we're going to obviously call you and say, this is a situation, this is our recommendation, we already have a team on board ready to take care of the situation, what would you like to do? But if it's more of a, the air conditioner broke down, or the air conditioner no longer works, we generally manage that. Much of the time, the cost of the repairs can be taken out of the cash flow. For example, new roof. New roof is about $3,000. If that should occur, and you don't want to pay out of pocket, generally we can get that leveraged over time out of the cash flow of the property. So you don't have to worry about that.
So this is a complete rehab property?
Yes. Yes, you can, I'm sorry.
I noticed at $32.01 a square foot, I've personally built many homes and many properties, and I can't go to Home Depot, buy the lumber and the nails and the paint, and if I did all the work myself, I couldn't do it for $32.
Absolutely. Absolutely.
So I don't quite understand your function. You're functioning as a property manager and you set the transaction. What exactly?
Well, right now, we have a third party that sources the properties and manages the properties. What we act as the manager for the process and the assets themselves. So once we've chosen the piece of property that makes sense for you, then we will manage those assets from there on out. Okay. So now this is going to get $5,000 a year. Okay. So you may say to me, hey, take $400 of that income that's coming in every month, and I want you to buy $300 worth of silver and $100 worth of gold. And so we'll go to Roll Metals and we'll buy that incrementally on your behalf. Let's say that you have a daughter who's getting married in 3 years. You want $25,000 out of this. We'll manage this until that $25,000 is needed. Here you go. Here's your $25,000. Or if you want to do this yourself, you can do it yourself. You can be self-directed through this. You can take any portion of control of this that you want. But I find that most people really would rather have somebody manage this for them because it's the largest return on investment you're going to get if we manage it for you. Because you're going to forget about it. You're going to put off that decision. Whatever, you've got a boat trip this weekend, but that roof really needs to be fixed. Or you didn't sign that paper for that, that lease agreement. Now you got to wait 2 more months or whatever.
So your function then, not only in marketing properties, but you're also a a creator of self-directed IRAs.
Absolutely.
That one could almost put anything within reason inside that qualified account of your choosing. Vacation home, metal, stocks, bonds, mutual funds, all the normal, but the unconventional. In my defined benefit plan, I'm an old car guy, and my wife and I have two 1936 Cadillacs. One's convertible and one's a hardtop. Both white with red leather. I made my business card out of it, but these are both owned by my pension plan. I can't go to Merrill Lynch and buy a 1936 Cadillac for my pension plan. From what I have in this cars, versus what they're currently worth today, it's 5 times my money.
So basically what this does is it gives you yield. The yield that if you decide that the IRA is a good situation, or a 401k, or a defined benefit plan, it doesn't matter to us which plan it's in. It can take and place that asset so it yields again, and your retirement starts to grow. If you buy this out of your IRA, out of your pocket, you still get all the tax benefits such as depreciation with it. Yes, John, you had a question? Okay. So it's not just qualified plans, it could be non-qualified plans, or it could be a mix. Maybe you want to take and you want to partner with this. So put $21,000 in yourself, $21,000 in the IRA, half the money goes to you, half the money goes to the IRA. Completely up to you how you want to do that. So there is a zillion and one different programs we can put together for this that make sense for you. There are some people that may find a piece of property out here that makes sense to purchase with their IRA, and they may be 5 years away from their retirement. And they're thinking, man, I would really like to have that beachfront for my retirement. For myself, but the only thing I have is my IRA. We can do that for you to show you how to do that. So that's the role we play as managers, is to help you strategize and help you work through what is necessary to get to that next step. The number one thing I have found with self-directed IRAs is people do not have an exit strategy. It's easy to go out and buy a piece of property or whatever that you want to buy. Getting out of it can be difficult if you don't do it correctly. Right? And that's, again, what we would help you for. In the beginning, we're going to say, do not buy that piece of property. It's the wrong one for your IRA, given that you're telling me you're going to retire in the next 2 years. Or, here's a better piece of property for you. Let's take a look at this one. This one makes more sense for you. So that's the role we play.
I also understand if you offer notes, if someone says, owning real estate for us isn't what we want to do, but we wouldn't mind lending some out on some notes.
Yes, we do. Let's see if this is here we go. So in this particular case, this property has a 9.47 rate of return. And I'm going to pick on Tootie over there. Tootie bought this piece of property, and she's very irresponsible. She just won't take care of her stuff and won't pay her what she owes you after month number 5. So after month number 5, you can call the note, and we can typically foreclose in about 10 days because it's a contract, right? All right, so once you own that piece of property, it becomes a 31% return on investment for you. Who's managing that piece of property? Moi, for you. It's the same thing as having a note. But if that note continues and Tootie repents and becomes a good girl, then you get a return of about 9.5% on that note for that 5-year period that these notes generally exist for. Any other questions? I can see the wheels turning on.
You've never seen it, I got some familiar.
Were the returns as good? Good.
Daniel, I think the control that you offer your clientele is absolutely abounding. And your product is definitely here at the right time in the right place. I want to thank everybody for coming today. We may have another seminar at 4 o'clock today. I've been listening to one.